Welcome back to the channel of Truth, Trust, and Transparency. Today, I'm answering quite an interesting viewer question. Now, the viewer question came on my YouTube channel. Good friend of mine from Will, he asked, and this was on the back of a deal that was for $229,000. He said, "Great vid, Dave. I was surprised to hear your thoughts about this deal being suited to a first-time investor. Maybe if they had no other choice, ? But even then, I feel like a first-timer should look at a capital city unit or something. You have 500k red bricks in far southwest Sydney, like Liverpool, Fairfield, etc. Would this not be more appropriate for that investor with a few runs, but who is close to capped out, e.g. can only lend less than 400? The more seasoned investor has the portfolio base to still generate equity whilst maximizing every last drop of lending with an asset in low vacancy, high yield locations. Very keen to hear your thoughts here, especially since I'm tossing this up myself. Maybe a video idea." Will, I totally agree, and is a video idea that I am putting together today for you. Now, the reason why I said that it was for a first-time investor, because the purchase price is $229,000. Now, if I go back and I say a $229,000 purchase price and you're putting down a 12% deposit, meaning you're going to be loaning about $200,000. Now, if I divide that by about 5, it would be for someone that is on about $40,000 to $50,000 a year. So, as I said, entry-level investor, this would be someone that is earning that sort of 40 to 50 grand per year. I've got a lot of young people that watch my content. I've got a lot of people just starting out in their careers, just getting on and through any sort of study and just getting those full-time jobs where they have 40 to 50 grand. So I think we're looking at two different things here. One is you're looking at a $200,000 lend. You're needing 40 to 50 grand to purchase into, to get into the market. I don't disagree with you, Will, and I think for the 500 or the 450 that you will need a little bit more you will need a little bit, probably double the borrowing capacity, say 400 grand, to get into those assets. So it would just be, again, for someone that is a little bit further along or has a little bit more income or can buy that particular property. Now, let's have a look at a little bit of the data, because I don't disagree, and I think what's interesting in the apartment market is this idea of replacement value. Let's jump into it and I'll show you guys what I mean. Okay, so again, looking at Liverpool, New South Wales, and to go to on the back of that replacement cost, and this is why I see a lot of buyers agents make the argument for it. I get it, but ever since COVID and building costs going up, say 20 to 30%, almost any property sub $600,000 is below replacement cost. So I wouldn't let that allow me to pick the asset type because of below replacement cost. I think that's a little bit of a cop-out, because anything under 600,000 is probably going to be below replacement cost. That's my opinion. The same could be made for the regional town and the houses in that deal for $229,000. You know, that's almost the price of a granny flat these days. So that as well would be below replacement cost. But let's look at the data. So look, Liverpool, New South Wales, Southwest Sydney units. You do have the price discrepancy between 2 and 3 bedrooms, which is about, in this case, $150,000. The issue that you have when it is a unit, though, is you have very few levers to pull, unless you're looking at a apartment with an extremely large, generous floor plan. It is unlikely that you will be able to tack on or add in a third bedroom. So the 2 to 3 or 3 to 4 bedroom arbitrage isn't a huge play there. In terms of dwellings and population size, big, established, we know where Liverpool is. It's almost a satellite city. It's on the M5. It's a well-serviced location, probably 45-50 minutes out of CBD. Now, growth rate cycle for Liverpool units, if we follow the 5% growth rate along, between 2012 and I'd say 2015, 2016, we had 5 years of good growth there. We also, which is very interesting, is that units were almost counter-cyclical to every other asset type during that COVID period. As we look through a lot of these growth rates for a lot of other houses and freestanding, we saw a huge spike during COVID, whereas units went the other way. Now, why did this happen during COVID? Well, maybe there is a bit more of the story for us to look at. And at the moment, we're looking at sort of 2 to 3%. Nothing fantastically great. But look, URSAD of 1, lower URSAD area. And this could be the reason for this sort of growth area here. 61% rented to owner ratio. So that is extremely high. But we also know that it is their 80% unit to houses ratio. 80% units to houses ratio. 61% is extremely high, and your issue there is you have that volatility, and it's not as if Liverpool is a blue chip suburb compared to your Bondis or your landlocked eastern suburbs. Liverpool all the way out to St. Mary's and Penrith, it's not exactly landlocked. So you do have that sort of volatility in the market. We can see here demand is for the 2 bedrooms. So even that conversion to 3 bedrooms may not be a great play because of the demand. 32.9 years to own affordability tells me that there's a little bit maybe of a margin there, but until that becomes over 35 years to own. What's great about this is there is stock on market is decreasing, inventory decreasing, building approvals. Now, you need to be careful, and I would question this graph because I know there are a lot of approvals in Liverpool, and this is 13 approvals at 5,000 K is $5 million worth of approvals. I think there may be more in Liverpool CBD. I'd need to check that against Liverpool Council. Vacancy rate has been dropping over the last 4 years and sits at 2.49%. Here it's in orange, but as we can see the trend, days on market's trend. So there's not a lot of stock on market in terms of listing. Days on market is low, and vacancy rate seems to be quite low too. Now, the issue that I think you have, 1, affordability, but I think there's a little bit of room to move. 2, your volatility in renter to owner ratio. But above all, I think one thing you need to realize and think about with units is that it also depends a lot around the type of unit that you're buying. Now, Fairfield is pretty similar data points, although a little bit more stock. Pretty similar data points that we've seen. Almost 35 years to own, 58% owner-occupier ratio. We have a bit more volatility in this unit market. Harder to predict also. 1 URSAD and about half the size of Liverpool. Hashtag glitching, doesn't show me there. But one thing that I would do if I'm considering this, Will, is I would be looking at what is the land component in which I can get my hands on and for what price. Because we can't really assume. Here's the thing, right? Let's look at the last 12 months of growth. The last 12 months of growth has been decreasing from 5 down to about 2.9. The last 12 months of data, if I look at this, right, the affordability has dropped off the last 12 months. Days on markets have dropped off, and vacancy rates, pretty much bang on. So my question to you is, are you confident that you're going to have capital growth in this particular market? Next thing I would also recommend you do is you go through and you look at the amount of units in the block. You look at the land component that you get, and what is the land, what is the value of that land? Because this block here, there could be 100 units in this block. So even if the land component was worth 10 mil, or if I've got 100 units, I only have a land value of $100,000. So ideally, like, I wouldn't be going into these massive, massive apartments. These are what would interest me. Ones that don't have lifts, that don't have heaps of body court fees or anything like that. I'd want to know an asset like this. What is the ratio between, for 465, how much land do I get? Again, another thing to consider, and I'm not trying to tell you what to do, but after I look at that, then I'm thinking about, okay, I don't have smooth, or it's harder to predict capital growth. It's also harder to force equity here because I don't have the value add that I do in a house. It's also more difficult here too to predict the growth pattern. It is also more volatile because 60% of this market is renters. Now let's have a look at the rental market. Apart from a few of these other ones, it looks like these sorts of red brick walk-ups will have about a 5.2% yield. Just off the top of my head, I combine for about 420, 450, 5.2% yield. So the yield is lower. You're going to have strata and holding costs. You may not even get a better portion of land value. I have less value add. Is the goal here, and why you would buy this, why? Location to capital city, because we know that isn't a data point that equals growth, because otherwise regionals wouldn't grow. Now, to circle back to, a couple of the questions. Would this not be more appropriate for an investor with a few runs but who is close to capped out, e.g. can only lend less than or 400K? If I'm an investor and I can lend 400K, I would be thinking of working my ass off to come up with a cash deposit. Now, if I can come up with a cash deposit of 100 grand, I can get into 500K market. I know that there are better markets in where I can buy a house, I can buy land in, your sort of Melbournes, in your regional hubs that are going to provide better data points than this. I think the question you always need to come back to Will, is where is the best place to spend what I have at this current point in time, and how does it fit into the strategy? So how would buying this unit in Southwest Sydney fit into your portfolio and your strategy? Because ideally these things are 50, 60 years old, so it might not be a full play. It might not be a full portfolio hold. And thinking out loud, would I hold that to the end of my portfolio to have as one of these assets that is paid off, that is paying cash into me? Well, probably not, because I know that the strata fees are going to get more and more expensive. So what is the point of it then? Is it a short-term hold, or is it a short-term mid-term hold? And if it is, what confidence do you have that you're going to get that? What confidence do you have that you're going to get that data that you need to be able to sell it and make a profit? Because as we can see from that growth data, it's very hard to predict what this market is going to do. So would I suggest it for an investor that can only borrow 4? No. If I'm an investor and I can borrow 4, I'd be looking to save up cash. If I can borrow money, if I can sell my car, if I can hit an extra job for 4, 6, 8 months and get into a house market. Whereas the example I used, and for that deal, that was someone that was like, when I say entry level, I mean they've got a job at a job that's paying them 40 to 50 grand. They have saved up 45 grand in cash, and they want to just get into the market. They won't be able to do that into this unit market. They won't be able to afford that. And for that sort of overall or that regional market, the data didn't look too bad. The replacement cost things there, and you're getting the trade-off of pretty much everything else. You're getting a little bit better certainty in data, less volatility, probably better yield. You're getting more value add potential. You're getting a cheaper purchase price, and you're probably getting a better house and land component. So to answer your question, the first time investor would be those with a very smaller budget, And then that way I have scope to hold that house long term. You know, I don't have to worry about body corp fees or anything like that. Maybe if they had no other choice, I think that's if they're first entering the market. Another thing you need to weigh up as well, and if you're listening to this in that first time investor on 40 to 50 grand, I think what you need to understand, what you need to consider as well is the time it takes you to save up and wait. So if you're on, you know, you're an entry level investor, you're on say 40, 50, 60 grand, and you can't foresee your salary rising too much in the next 3 years, and you know, the time it's taking you to save that 40, 50 grand, you need to make a decision and think, well, I can wait 3 years and try to get it, or I can enter the market now. And sometimes the cost of waiting and trying to save up, the market would outpace you. Whereas if you can lodge into some of those markets, you will have potentially better capital growth, and have your money working for you, compared to if you're just trying to save it. So who was it for? It was for that entry-level investor. I'm thinking 40, 50, 60 grand in terms of your salary, wanting to just get into the market. Would it be more appropriate for that type of investor to get into this? No, I don't think that they can afford it. And even if they could, afford, say, $500,000 unit, I would be still inclined to maybe push towards a regional bracket, a regionally based asset. Think your peripherals around like sort of your Ballarat areas, you know, you can still pick up in there, you know, those sorts of markets. There's some Queensland, there's some Adelaide markets too. There's some regional New South Wales that you can have a look at and still get a very decent asset at that price. I hope that has sort of answered the question and addressed who I recommended it for. Don't get me wrong, there may be plays for units. I think units work best when they are those walk-ups, but in slightly better located areas. I don't see anything in the data that is screaming for me to buy them. And I think replacement value, yes, correct. I get the argument. However, I'm not sure if that would be the place for it. But for your own situation, hit me up. We can talk offline, man. So yeah, that's the video for today, guys. Hopefully, maybe some clarification around those that are just entering the market and what they're looking for. It ultimately as well comes back to that plan and that strategy. So for that particular example, I'm basing that off someone with a low income that doesn't have the growth projections of the salary. Now, there's people out there that are like that and that just need to get that foot in the door and into the market. Compared to, you know, if your salary's at 70, 80, 90 and it's going to go up in a few years, we can sort of plan out what type of purchase and where that's at. But questions, thoughts, queries, let me know in the comments. And as always, guys, I will see you tomorrow.